Putting together a self-storage deal may seem overwhelming with everything that's included. There's a lot that goes into putting a self-storage deal together. Let's break it down simply and look at all the things that go into it and guide you through the actual structure of how to make a good self-storage deal. So there's a lot of ways that you can put a deal together, but for this example, we're going to keep it relatively simple and use what is normal within the industry. To break it down, we're going to use three different parts: the deal, capital, and work. So first of all, you have the deal itself, finding the deal. We generally find deals through brokers, wholesalers, or you out hitting the streets, making connections with owners, and trying to find somebody that will sell you a self-storage deal. Once you have that deal, we move on to the second part: money. You need capital to buy the deal. Generally speaking, there are three different parties. We have you, the bank, and investors. Now, sometimes you don't use investors, other times you only use investors. At the end of the day, that bank loan will generally take up 70 to 80% of your capital needed, and investors or you will come in at 30 or 20%. Of course, we have other types of loans you can use, and that will depend on the product and you. Things like small business loans where you can actually put less down, but we're not going to go into all of those today. And we have, of course, work. Now, this is a big piece. Obviously, we have pre-close and after close. When you go into pre-close, you're looking at contract to close, attorneys, broker, wholesalers, you that play into the part, the banks. We have third-party reports like feasibility studies, phase ones, zonings, Alta surveys, property condition reports. After close, we have things like asset management, property management, legal, accounting, tech stacks, and service centers. All of the things that go into prior and after we're trying to put a deal together. So why are all of these things important? When you're putting together a real estate deal, you need to identify who gets what. And when we're putting a deal together, who gets what is determined by two things: equity and fees. Equity is the ownership that the individuals that are participating in the deal get. When it comes to fees, we are talking about the fees of the participants in the deal, okay? We're not talking about third parties, so we're not including brokers, things like that. We're just talking about fees that are going to the ownership in the deal structure. We can go really deep into this, and there's lots of ways to structure equities in the form of waterfalls and a lot more complicated things, which we're not going to get into today. There's lots more fees, but we're going to start with the main ones, and we're really going to focus on the basic structures that are generally seen. Generally speaking, when we're talking about equity, the sponsor, the individual that we call the general partner, the person putting together the deal. Now, this may be one individual or this may be multiple individuals. The general partner is given a share or a percentage of equity that is not predicated on capital he's investing. Most general partners, like me and others, are also limited partners. The capital that I invest is in a limited share, but the general partner gets equity for putting the deal together and doing a lot of the work and bringing this investment to those investors. We have limited partners or investors. These are people that are generally only putting in capital. They are not doing any work, and they own LP shares, and they are limited on risk, but they are also limited to control. Now, we're dealing with equity, but equity ownership is one part. Lots of ways that you do it. The general partnership may get equity, but he wants to ensure that his investors, those limited partners, are getting a return, especially before him. So we put in things like, I use an 8% pref, as we call it. An 8% preferred return. All that means is how the revenue flows through the equity positions. You're guaranteeing the investors 8% return on their money before you're taking anything, putting them first, ensuring them a good return. This protects your investors and builds a lot of confidence. Now, you'll remember when we talked about work. There's a lot of work that goes to finding deals, getting deals all the way to close, and then there's ongoing work when it comes to running a storage facility. These may be property management, this may be asset management, investor communications, accounting. A lot goes into it. The fee structure is designed to pay for that work. We normally see an acquisition fee, let's call it 2%. That is what that person is paid for putting that deal together and bringing it and getting it closed, getting the investors in, and getting it operating. That is based upon the price of the acquisition normally. Ongoing fees, such as property management or asset management, these fees are generally paid as revenue. So property management, we see at 6% fee off the gross revenue. The asset management is a 2% fee off of gross revenue. Now, once again, it's not always 2 and it's not always 6. That depends on circumstances, but these are normal ranges. Asset management usually goes to like the private equity part. These are people that are dealing with the investors, they're doing communications, things like that. Property management is dealing with the asset itself. This is tenants, this is making sure that it's up to date, looking good, this is running the day-to-day operations of that asset. These are paid ongoing. Now, it's important to know that just because you're a general partner does not mean that you do all of these things, right? Many general partners do not do the property management at all. That is hired out to a third party. So when you're dealing with fees, fees are appropriate based upon the works and the needs of the asset. So when structuring the deal, you need to look at the first 3 parts, all the things that go into the deal. And from there, you can work out with the investors the breakdown of equity, who gets what, and then what fees are being paid to do the work and make sure that this investment is a successful investment. One of the reasons that deal making can seem complex is there's so many ways to go about it. You don't have to fit an exact structure. You work with investors, with property owners or brokers. You put together what makes the deal work best. Many times when you're starting out, you have to give up equity or maybe not be able to charge fees. Lots of times you may have a deal that is very specific to you. You originated that deal and you can command a lot more equity because the returns of the deal are going to be higher and they're specific to you. There's lots of things that go into it. But this is a standardized structure that we see take place a lot. We believe a lot in frameworks and teaching frameworks that you can use when you're out putting deals together. These are examples of frameworks that you can use. From here, you can look at what the sponsor should take, what the investor should take. You can line item fees, what's appropriate, what's not. Now, although we've talked a lot about work, about finding deals, about capital, and all the things that go into it, and how to split up equity and what fees should charge, you have to remember, this is all very much predicated on what that deal can do. Just because you want to give high preferred returns or you want to take more on the fees doesn't mean that that deal can support it. You have to look at the revenue and the total returns to see what that deal can support. It needs to be aligned with your strategy, and you have to make sure it's worth it for you as well as your investors. Okay, now that you know this, you can start looking at deals that are on the markets or maybe deals that you think you would want to buy. And you can look at all the things that you need, capital, third parties, and start to digest all the things that would go into that deal and how you would structure the different parties, capital stacks, and everything that goes into it. Play with this. This is going to be a lot of practice and a lot of understanding what you have to offer, what you need, and the opportunities at your disposal. You want to make sure that your self-storage deal will succeed? Well, check out this video on analyzing a market to make sure that the market can support your self-storage facility.